Welcome back, my friends. Wells Fargo, once the top U.S. mortgage lender, is stepping back from the housing market. Its previous goal was to lend mortgages to as many Americans as possible. The bank will now offer home loans only to existing bank and wealth management customers. It will also focus on borrowers in minority communities. Wells Fargo is also shuttering its correspondence business. That business sells mortgages through third-party companies. That significantly shrinks its mortgage servicing portfolio through asset sales. This will lead to a fresh round of layoffs for the bank's mortgage operations. But Wells Fargo declined to quantify exactly how many new layoffs there would be. So, what does this mean for the housing market? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Wells Fargo is stepping back from the multi-trillion-dollar market for U.S. mortgages. This comes amid regulatory pressure. And as the Federal Reserve continues to raise interest rates. Wells Fargo will now only offer home loans to existing bank and wealth management customers. The banking giant thinks that the lending market has collapsed. Wells Fargo is also concerned about and heightened regulatory oversight, both industry-wide and specific to Wells Fargo. If you recall, Wells Fargo was the subject of a 2016 fake accounts scandal. We are acutely aware of Wells Fargo's history since 2016, Wells Fargo spokesperson said. And the work we need to do to restore public confidence, the spokesperson said in a phone interview. As part of that review, we determined that our home lending business was too large, both in terms of overall size and its scope, the spokesperson said. This move is the most strategic shift that CEO Charlie Scharf has undertaken since joining Wells Fargo in late 2019. Mortgages are by far the largest category of debt held by Americans. They comprise 71% of the $16.5 trillion in total U.S. household debt. Under previous CEOs, Wells Fargo took pride in its vast share in home loans. Wells Fargo was the country's top mortgage lender as recently as 2019. Now Wells Fargo pursuing more revenue from investment banking and credit cards. Wells Fargo will more closely resemble megabank rivals, Bank of America and J.P. Morgan Chase. Both of these big banks backed away from mortgage market share after the 2008 financial crisis. Non-bank players including Rocket Mortgage quickly filled the void. But these newer players aren't as closely regulated as the giant U.S. banks are. Critics of the U.S. mortgage industry say that could expose consumers to pitfalls. Wells Fargo is the third largest mortgage lender behind Rocket and United Wholesale Mortgage. Wells Fargo is also shutting down its correspondent business as part of its retrenchment. The correspondent business buys loans made by third-party lenders. In fact, Wells Fargo is significantly shrinking its mortgage servicing portfolio through asset sales. The correspondence channel is a major business segment for Wells Fargo. It actually became larger as overall loan activity shrank last year. 42% of the $21.5 billion in loans Wells Fargo originated in the third quarter were correspondence loans. The sale of mortgage servicing rights to other industry players will take at least several quarters to complete, depending on market conditions, Wells Fargo said. Wells Fargo is currently the largest mortgage servicer in the United States. Mortgage servicing involves collecting payments from borrowers. That business has $1 trillion in loans, or 7.3% of the overall market. Altogether, the shift will result in a fresh round of layoffs for the bank's mortgage operations. But Wells Fargo executives declined to quantify exactly how many positions would be cut. Wells Fargo cut thousands of mortgage workers last year as business declined. The news does not really come as a complete surprise to investors or employees. Wells Fargo employees have speculated for months about changes coming under CEO Scharf. But he actually telegraphed his intentions several times in the past year. It's very different today running a mortgage business inside a bank than it was 15 years ago, Scharf told analysts in June. We won't be as large as we were historically in the industry, he added. Wells Fargo said it was investing $100 million for minority homeownership. They are placing more mortgage consultants in branches located in minority communities. Our priority is to de-risk the place, Wells Fargo said. We want to focus on serving our own customers and play the role that society expects us to play as it relates to the racial homeownership gap, Wells Fargo added. The mortgage shift is probably the last major business change Scharf will undertake. If you recall, Scharf split Wells Fargo's operations into 5 divisions. Scharf does not anticipate doing other major changes. But he said that the bank will need to adapt to changing conditions. Given the quality of the 5 major businesses across the franchise, we think we're positioned to compete against the very best out there and win, whether it's banks, non-banks or fintechs, he said. Real estate values have fallen across the nation. And macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. Blackstone and Starwood Capital Group are drawing attention from the Securities and Exchange Commission. The real estate funds have recently seen a surge in withdrawal requests. It comes amid a broad drop in investor sentiment and potential economic downturn. This led both private equity giants to pause redemptions. After monthly and quarterly withdrawal limits were reached, investors in and outside of the funds took notice. As has, apparently, the SEC. The regulatory agency reached out to both Blackstone and Starwood. The agency was looking into how the firms served redemptions to their clients, and if any affiliates of the 2 companies sold their shares before the clients, according to one of the sources. The inquiries are not indications that either firm is under investigation or committed any wrongdoing, the report said. Representatives for Blackstone and the SEC declined to comment to Insider. Assets flowed into the fund and it was a success, at least for a few years. The Blackstone right amassed $68 billion in assets. But what a difference a year makes. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private right. As you might imagine, in a degrading real estate market, publicly traded rights have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BREIT. Just as a comparison, the $35 billion Vanguard Real Estate ETF has plummeted 26% year to date. Well, despite that so-called confidence, investors in the fund sent double the normal amount of redemption requests in November. New subscriptions in the fund experienced a major drop-off. Subscriptions fell to less than $500 million. That compares to $880 million in September. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. Meanwhile, Redfin shut down its institutional home buying. And it is selling off its portfolio of homes as quickly as possible. That has crushed buyer demand and cratered values in real estate investors' favorite cities. Phoenix, Las Vegas, Jacksonville. It is a stunning reversal of fortune for flippers. They are now stuck with homes to sell and with loans to pay. Home flipping reached a fever pitch at the start of the year. Demand has cooled spectacularly fast in Sunbelt cities. Phoenix, Jacksonville, and Atlanta. Pandemic-era boomtowns where affordability has been strained. Boise, Salt Lake City, Denver, Las Vegas, and even Austin. Betting on rising U.S. real estate prices was a winning strategy for at least a decade. But prices seem to be declining every week as sellers get more desperate and buyers back away. Home builder sentiment is in a record collapse. New home sales are down almost 30% from a year ago. And existing home sales are down 20% from a year ago. Sensing that home prices are in free fall, home buyers are now pulling back from the market. The United States economy now teeters on the brink of recession. Housing prices are falling in many U.S. cities. But how far will they go? Experts predict that house prices could fall by up to 25% over the next few months. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.